By now, you have heard the story of SVB, which is Silicon Valley Bank. Now, you may have never heard of Silicon Valley Bank, and that's okay. I was no expert on Silicon Valley Bank either. I didn't know that it was the preferred bank of groups like Y Combinator, which helps with startups. I didn't know that it was a bank utilized by groups like Etsy and many, many other companies, and is responsible not only for payroll of those companies where money is going in and out, but also responsible for how a lot of those merchants get paid. The connections to Silicon Valley Bank are really far and wide reaching. Tony Katz, good to be with you. Tony Katz today. The other thing I didn't know about Silicon Valley Bank is how big it was. You hear Silicon Valley Bank, you think it's some little local bank, over $200 billion they were dealing with. And then on one day, last Thursday, the shares went down 60%. And on the next day, it was California and their the watchdogs, if you will, decided that, hey, this bank can't actually be a bank, and trading was halted on the exchange. And the next thing you know, you have got industry leader after industry leader saying if the federal government does not cover the losses of this bank, the results for all of us will be wholly catastrophic. I mean, that's the words they're using. If you ever wanted to see people actually in panic, actually in fear, this is what it looks like from every bit of reporting. Dr. Matt Will joins us right now, economist at the University of Indianapolis. And sir, let's take a step back here. Talk to me about what caused this bank to have this capital crunch, this cash crunch, and then to have its trading halted by the exchange.
Well, Tony, let me step back and say people have to look at two things. Silicon Valley Bank is one, and another one called Silvergate Capital. These things go hand in hand. Silvergate Capital had a tragedy that happened recently, and Silicon Valley Bank is the one that happened just now. The cause is very simple. I've been talking about this since last year, Tony. I'm frustrated that people aren't listening. The cause is simply government regulation and the attachment to crypto. We'll talk about both. But government regulation is the primary problem here, Tony, and because banks have two kinds of risk. There's two kinds of risk. It's very simple: interest rate risk and credit risk. And we're going to talk about both of those, Tony. People don't realize that's all there is to it. In fact, I could teach an entire course on this. I do teach an entire course on this, but we're going to cover it here just in a few minutes, Tony. And I don't know, you want to start with the interest rate risk or credit risk? It's your call.
Oh, dear Lord. Which came first, the chicken or the egg?
Well, that's a different story, but the answer is the chicken. So let's start with the interest rate risk, because, Tony, that's what's happening here. Regulators are idiots. There's this thing called duration. Duration is how, I won't get into the details of it, but it's kind of like how long a loan lasts, how long a liability lasts. These must match. Your asset duration must match your liability duration. And Tony, here's what it is in very simple phrase. Long-term assets of the bank, long-term assets, we're making 4% return. Their short-term liabilities, Tony, costing about 4.5%. Tony, that's against the law. Some regulator wasn't doing their job. You can't have a long-term investment making 4% and you're paying for it with a short-term 4.5%. That's not possible, Tony. You're losing 0.5%. And when interest rates go up in the short term, which they've been doing, that makes the loss even worse. And they're not allowed to do it, Tony. Regulators are supposed to catch this. They're supposed to catch interest rate risk daily. It's monitored daily. It's reported to the government daily. And someone was asleep at the switch. And I don't think it's an isolated case, Tony. I think it's systemic.
And that's what has people very, very afraid. Talking to Dr. Matt Will, economist at the University of Indianapolis. So which part was that one? You had said two things. I want to make sure everybody is clear on which part that was.
That's the interest rate risk, Tony.
Okay.
When you're making 4% on your investments and you're paying 4.5%, that's interest rate risk.
Well, and now the other side of this, the
well.
egg part was
the credit risk, Tony. People have to pay back their loans. So when you go to Silicon Valley Bank and you borrow money, you have to put up collateral. You have to put up real assets. This company called Silvergate Capital, they were also having to put up assets when you borrow money. Tony, you and I go into to borrow money. We have to have collateral. If you don't pay back your car loan, they take your car.
Right.
That's a real asset. Banks have been loaning money on crypto. Tony, borrowers own crypto. This is not an asset. It's something that's like, for example, there's this company called Circle USD Coin. It's a stable coin. It's worth 87 cents on the dollar. That's collateral, Tony. So, can I use the analogy of gambling? Because that's what it is. Now,
sure.
Don't get me wrong. I'm not against crypto. Crypto is gambling. People can do it. No problem. But it shouldn't be in banks. And banks should not accept it as collateral. So picture this, Tony. What if you go into a bank and you say, I want a loan? And they say, well, we need some collateral. What assets do you have? And you say, you know what? I made a bet on FanDuel for next week's football game. Will you take my bet slip as collateral? Tony, that's what these banks are doing.
So now
I know it sounds funny, Tony, but that's actually what they did. And that bank slip can go, that bet slip, you bet $200, it can go up to 400 or down to zero. The difference is with crypto, it could double or it could go to zero too, but it's going to take longer period of time. It's the same thing.
So now you've got this investment side and you have this credit side, right? You have the issue they had with their investments and the issue you had with the collateral they took. Let's go back to this investment side because this gets very, very confusing. The bank holds the money. The bank is making interest on the money. Money's coming in, coming out based on the company. What investments are you referring to that the bank was making that didn't allow them to make money on the money they were taking in and had to pay out more?
The investment of a bank is a loan. That's how they make their money. They give you a loan. They make money off that loan. But where do they get their money to loan to you? They get that from depositors. And right now, their investments, which are loans to you. I know it sounds confusing, Tony. My students don't even understand this sometimes because we use the words that are confusing. An investment to a bank is a loan. That's how they make their money. That's their assets, is loaning you money to buy your house, and they think you're going to pay them back. But Tony, where do they get that money from? Depositors. Depositors can pull their money in a second. You can walk into that bank and take your money out of the bank. Tony, that's what's happening to Silicon Valley Bank.
So now
they've got this loan.
I'm going to jump in because I want to follow this my way. One of the things that I have been reading in the reporting was that one of the things Silicon Valley was doing, it was about the buying of bonds, and the bonds, they weren't paying back at the rate they needed to. Is that part of the conversation you're having here?
It is. That's a separate part of it, though, Tony, and that is that the banks have assets on they own bonds on their balance sheet. These are the things that make them look healthy, is they own all these bonds, government bonds, treasury bonds. They own these bonds. They own other bonds. And so when someone walks into the bank and says, I want my cash, they say, oh, well, we'll give you your cash. Here you go. But what if they don't have enough cash, Tony? What if they don't have enough cash? They have to sell their assets. They can either sell one of those loans they made, or they can sell a treasury bond. You know, that free money the government's been giving them, Tony? Mm-hmm. They have to sell it. And guess what? Those prices are down right now. And the government hasn't required them to decrease the value on their balance sheet. Does that make sense?
It sounds horrifically convoluted. They have these bonds. They can sell them if they need to get money back to one of their depositors, but the bond isn't worth what it was because interest rates have gone up?
Yes. Tony, what probably doesn't sound convoluted. You said it perfectly. Maybe you should be.
Well, I didn't know how I don't know how I got it perfectly, but go through that again.
So, Tony, when people walk into the bank because they're nervous that the bank is going to fail and they say, I want my cash. The bank has some cash sitting around and they'll give them some cash. But if they run out of cash, they've got to sell one of their assets. Tony, they have two basic assets, loans that they've made to various people, and they have treasuries sitting there, treasury bills, treasury bonds that they bought that the government sold them. All this easy money over the last few years. They had to sell those at a loss, Tony, because rates have gone up. And the way it works mathematically is when rates go up, bond values go down.
So the rates are down, bond values go up. The rates go up, bond values go down. The bond that they bought when the rates were 3% is now worth much less now that the rates are at 5, 6, and 7%, and they weren't able to catch up with the needs of their depositors. Talking to Dr. Matt Will, economist at the University of Indianapolis, you talk about the regulators not catching this. How did the depositors at the bank catch this? Because I have a bank, you have a bank, everybody has a bank, and now they're asking themselves, what the hell's wrong with my bank? Is my bank about to fold? Do I have to go get my money out on Monday, or today or tomorrow, whatever it is? How is it that people notice this bank doesn't have my money?
Well, Tony, they found out by word of mouth. It started back Tuesday and Wednesday. I know people who are in the finance industry who saw that this bank was not doing things properly and the government wasn't regulating them properly. People saw this last week, and there's a massive short sale on the bank. So the sophisticated people knew what was coming, Tony.
So the short sale comes from the market. I know I'm interrupting, but I want to make sure we're bit by bit. The short sale came from the market because it's a public company, and people saw this and said, I don't want any part of this at all. And that's when you started seeing the stock slide, and it slid 60% on Thursday before it was shut down on Friday.
Yes, you said it. That is correct, Tony. So the sophisticated investor saw it first, but the Main Street person who's banking with them, they didn't see it till later because they didn't understand the complications and the problems with this company's balance sheet that the regulators didn't monitor and the regulators didn't see it earlier, but people on Wall Street saw it.
Okay. So now we get to how it is that the regulator or the regulators didn't see the problem. Because if you were to look at this politically, I already have every progressive Yahoo in America screaming this is because Trump deregulated the banks and you got rid of Dodd-Frank and things like that. Does this have anything to do with Trump? And what is it that the regulators missed, and how does that happen?
Tony, it is the opposite. It's the regulators who caused the problem. And I'll give you a simple example. The number one thing that regulators monitor is this thing called duration, which, again, I said at the beginning, that's where you match your assets with your liabilities. They shouldn't match.
Okay.
I can give you story after story, personal, firsthand experience of regulators who walk into the bank and say, what's duration? And the banker has to explain it to them, even though it's their number one measurement of risk, Tony. It's the number one way that the regulators measure risk. And the regulators don't even know what it is. Now, I'm not talking Jerome Powell and Janet Yellen. I'm talking a person who walks in and knocks on the door of the bank. I have firsthand personal experience of this. And the reason is simple, Tony. I teach these people. I taught them now. I taught them when I was at Johns Hopkins University. The worst of my students become regulators in the banking industry, Tony. The worst. The best ones are going to work for the banks and for the investment banks and for Wall Street. So you have my worst students going in, not even knowing the definition on a test, and they're regulating the bank. Tony, the people at regulating these banks are the incompetent people. They're not the talented people. And I know they're going to call me and yell at me and send me nasty grams, and I'll give them proof.
Talking to Dr. Matt Will, economist at the University of Indianapolis. Like the video? Don't forget to subscribe on Rumble. Rumble.com/Tony Katz. Get it done. Let's now take this in a different direction, sir. Dr. Matt Will, economist, University of Indianapolis. Me, I'm Tony Katz. Tony Katz today, continuing this conversation about Silicon Valley Bank and the disaster that has unfolded there with the bank basically being shut down. And you have government officials, you have people who are well entrenched in business, from Home Depot, Mark Cuban, owner of the Dallas Mavericks, and others saying the federal government has to make this bank whole because the contagion possibility is absolutely horrific. When they say contagion, I think it's Bernie Marcus from Home Depot, when Mark Cuban talk about the idea of contagion and being contagious, what do they mean?
Tony, they're looking for a bailout like in 2008. Contagion means that the same thing can happen to the next bank and that people will run into the bank and they'll say, hey, give me my cash. and then the bank will have to sell their assets at a loss, and then they'll go bankrupt again. That's what they're concerned with. On the surface, below the surface, Tony, they're looking for a 2008 style bailout. We should just let this bank fail, let the next bank fail. A few of them will go under. That's fine. You and I will be protected because we have FDIC insurance. And Janet Yellen and Jerome Powell made an announcement Sunday night where they said, we're going to open the bank Monday and everyone's going to get their cash out. But Tony, they didn't say if it's the insured people
right,
or if it's the Mark Cubans of the world. The Mark Cubans of the world should not get their money out because the limit is $250,000. And so I want to know if they're going to do a backdoor deal to help the billionaires rather than help Joe on the street who should get his money back because he is guaranteed and insured.
So let me go on this tangent with you, and then we'll come back. The issue with Silicon Valley Bank is that it was the darling of Silicon Valley. It's the place that people say, well, this is where you go. And there are numerous companies that do business with Silicon Valley Bank. But as Time Magazine reported, 85% of the depositors and deposits at Silicon Valley Bank were uninsured. The FDIC, a Federal Deposit Insurance Company, does guarantee money up to $250,000 for a depositor. But we're talking about companies that were running millions of dollars almost a day through the company. They were doing payroll and doing their buying and everything else. These are the people who you're saying there should be absolutely no bailout for. And I agree with you. This is a conversation of a bailout. There should be absolutely no bailout for. And if that's the case, what you're saying is there's no such thing as too big to fail. And these companies are going to suffer huge.
Yes, Tony, because they were rolling the dice with someone else's money. And that's what happens when you're a venture capital company inventing some new tech that doesn't go anywhere. You should lose your money. That's how it works.
But the
taxpayer should not bail them out.
But the company itself, XYZ company, Katz Incorporated, Will Enterprises, they didn't do anything wrong. They put their money in with the bank. Why is the conversation that they are, out of luck because the bank went under based on how you've described it here, sir, that it's the regulators who didn't catch the failings of not having enough cash to handle what it is the bank was doing?
Well, Tony, first of all, a smart bank, a smart company, I should say, will use the appropriate bank with the appropriate capital. We're not going to go to some bank down the corner that's only been there for 5 years. And by the way, those 85% of the people in that bank, those are the speculative companies. Don't let them confuse you, Tony, by saying, oh, it's the worker, it's the meat and the payroll. It's the payroll of a company that was rolling the dice with someone else's money. Tony, do you want every person in the world to start a company, hire a bunch of people, and then roll the dice with your money?
I get the point if you're arguing that somebody was being speculative. But for example, Etsy vendors are not getting paid because Etsy has a lot of their money wrapped up with Silicon Valley Bank. Is that vendor at fault?
Now, Tony, you're talking about, now you switched gears on me. The transaction of payments. So when you go into a restaurant and you make a payment with your credit card, that transaction, ownership of the money has changed hands, even though it hasn't moved from the bank to the other bank yet. So you're talking about transactional relationships versus assets on deposit. Transactional relationships should continue to occur, and I'm positive or hopeful that the Fed will make sure that all those things happen. And I'm pretty sure that's what the announcement Sunday night meant.
So if you are an Etsy, I'm using them just as an example here, and you had $50 million in with the bank because people were ordering this and ordering that and ordering the other, are you saying that the federal government will make their $50 million whole? Or should?
See, Tony, we're still not getting to the details. If you've made a transaction and that money is yours, but it's on deposit with SVB, then yes, you will get your money.
So those Etsy people will. So who is it that you're arguing should not?
The companies who have their own cash on deposit with the bank.
Because those companies didn't do their due diligence and weren't actually demanding the proper information. These should be sophisticated people and sophisticated investors and depositors, and they weren't.
Yes. Yes. There's banks called custodians. There's banks called prime banks. Those banks are at a different level than this one is, Tony. And if you're a $100 million company and you don't have enough knowledge to pick the right bank to bank with, that's your problem. Tell me, Tony, if someone offers you 5% on your checking deposit, is that not too good to be true? And shouldn't you know better if you're a sophisticated company and a CFO?
Talking to Dr. Matt Will, economist at the University of Indianapolis. I know that question was rhetorical, and that's why I gave you no answer, sir. Now we get to what is the granddaddy of the questions. And I'm glad we went through that back and forth, because you have to make the distinction between these two entities. And you're making the distinction between the person who is doing basic vending, right? Basic buying and selling and utilizing the bank to move those dollars forward, and the people who were keeping their money in their bank, parking their money in the bank, because, as you say, maybe they felt they were getting a deal that was just absolutely terrific, but that deal should be too good to be true. Do you know of any advertised deals that bank was giving, or any rates that bank was paying that would fall into that category of too good to be true?
Tony, I don't have the examples in front of me. The time frame here is too short. What I do know from reading all the information that I've read is that they were taking what's called interest rate risk, which is where we started it. And they weren't neutral. Banks don't make money on spread anymore. They make money on what's called fees. So they when they gave you a loan, Tony, they usually then sell your loan to somebody else, and they take a loan origination fee. But this company was gambling. This bank was gambling, Tony, on spread. And so I don't know what they were offering, but I can tell you that it must have been an inflated rate, or they wouldn't be in the situation they're in.
So you think that's something we're going to find out about sooner rather than later?
Well, I don't know when. And because, again, I'm not sure the regulators are going to be totally transparent. I am concerned that the regulators in this case are going to jump in and they're going to bail the bank out, and they're not going to let the people who invested in this bank take the loss they should take.
And you feel that the regulators are going to do that because the regulators are covering for the regulators, because if they had been doing their job, it would have been known that they were paying out more than they were bringing in, and there's no way there's a level of sustainability at that moment.
Yes, that's exactly correct, Tony. That's exactly correct. And think about it. 85% of their customers are high-wheeling tech companies. Don't you think the bank is of the exact same ilk? And by the way, I believe that one of the executives in this bank was also an executive at Lehman Brothers, who was rolling the dice at Lehman Brothers before they went bankrupt.
The CFO of Silicon Valley Bank was with Lehman, and until a year before Lehman went under, I think, as their CFO. It's an absolutely crazy bit of coincidence. You could feel the air quotes just punching you in the face. Does this concern you, that we're about to see this contagion conversation, that people will certainly be concerned about their own bank, but that if the regulators have not been on the ball here, as you brought up earlier, the regulators have not been on the ball possibly anywhere, or certainly in specific spots? What is it that you think we as the American public could expect to hear about? What kind of stress tests? We heard a lot about this after the financial collapse, 2008, 2009, stress tests for the bank. What could be going on there? And is this an excuse for the federal government to even be more restrictive with banks? And how does that affect us, the end user?
Tony, there's so much there. There's so much there. The last part of your question is easy. Yes, they're going to use this as an excuse to be more intrusive, and they're going to make matters worse. But there's two parts to the answer. Go back to 2008. You have to look at 2008, and you have to look at the fact that this was a minor problem that the government made into a major problem. There would have been a few banks going under. The market would have reacted, would have fixed everything properly. But then the government stepped in and made this a big problem. And I got a whole hour presentation I give on the details of that. Tony, this is the same thing. I'm very concerned that this contagion is isolated and that it's going to get bigger if the government tries to bail them out and bail out the Mark Cubans of the world. There's no reason Mark Cuban spoke up other than he must have an interest in this. Remember, this is a tech speculator. I bet you dollars of donuts that Mark Cuban is somehow involved somewhere along the line in his own risky ventures, and he wants to make sure these people get bailed out, so when his time comes, he gets bailed out. But Tony, your second part of your question was, is this a risk since the bankers are asleep at the switch, the regulators, I should say? The answer is not necessarily. Banks are very responsible. They're very solid. I can give you a laundry list of things that are good and people shouldn't worry about them because they monitor their own risk. This was the same guy who messed up Lehman Brothers, who was rolling the dice in Silicon Valley, who was not managing his risk like banks are supposed to manage their risk. Tony, he was an investment banker who became a banker. There's a difference between investment banks and banks. Banks are safe. Investment banks are risky. So we put a risky guy who bankrupted a company in charge of a safe bank. Tony, most banks are fine. Most banks are not letting this get out of hand. They don't make what we call spread. They're not gambling the dice on interest rates. So I'm not too concerned about the spreading, but it will spread. And where it does spread to, they should go under.
Dr. Matt Will, economist at the University of Indianapolis. I appreciate you taking the time to be with us. There is more to get to. Thanks for watching the video. Really hope you enjoyed what you saw and what you heard. You want to get more? Don't forget to subscribe on Rumble. Rumble.com/Tony Katz. Rumble.com/Tony Katz. Again? Okay. Rumble.com/Tony Katz. Greatly appreciate it. Subscribe, and you'll get more and more videos just like this. And you can join us on Locals as well. TonyKatz.locals.com.